The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. Here are your headlines today. Nvidia's record-breaking rally hits the skids. The stock plunges another 7% to raising $550 billion from the AI chipmaker's market cap since last week's peak. Chinese Premier Li Qiang tells the World Economic Forum's summer Davos in Dalian he's confident the country can reach its growth target this year, playing down trade tensions with the West.
The advanced electric vehicles, lithium batteries, and PV products made by Chinese companies have not only met domestic demand, but also enriched supply in the international market.
Elsewhere, Airbus surprising the market, slashing its guidance and tempering plans to speed up production of its best-selling A320 Neo aircraft as supply chain issues continue to weigh. And no to New York, fast fashion retailer Shein reportedly filing papers to list in London in what would likely be the city's biggest listing in more than a decade.
Well, first up, we're going to talk about the markets this morning, but we're going to narrow focus to Nvidia.
Yeah.
So it was the Magnificent Seven we were talking about for many, many months over the course of late last year. But this year, I think the focus has really just concentrated around one stock, hasn't it?
Yeah, I mean, look, I think there are always fascinating conversations we could do every single day about Apple, Microsoft, Amazon, arguably Tesla, certainly Meta. But this is the stock du jour, isn't it? This is the one where everyone is focusing their attention because it is symbolic of the thematic of the day, which is AI.
Yeah, and we used to have a conversation very similar to this around Apple. I think you were the one that used to always push back and say, do we really have to talk about Apple yet again?
Yeah, I felt like we were becoming, I'd be brutally honest, I felt like sometimes we were becoming an advertising tool for the company because It was always about, we spent disproportionate amount of time talking about Apple compared to other comparable companies and devices.
And here we are in 2024, and Nvidia is that stock, and there are market consequences here. While shares in Nvidia fell almost 7% in Monday's trade, marking 3 consecutive days of declines and wiping off more than $500 billion in market value since last week. Shares of the chipmaker, which became the world's most valuable company just a few days ago, are now down more than 13% from their peak last week. The stock decline follows news that co-founder and chief executive Jensen Huang sold nearly $95 million worth of shares in recent days. It also comes as investors pour money into rivals Apple and Meta amid reports of their joint AI ambitions. With a market cap of just under $3 trillion, Nvidia has now fallen back behind Microsoft and Apple as the third most valuable publicly listed company in the world. Nvidia's stock decline raised concerns over the impact on the broader tech index. Shares of other chip makers, including ARM, Qualcomm and Broadcom, fell, while other competitors in that space, such as Dell and Supermicro Computer, also posted declines. Well, let's just piece together this information. I think some believe there could be market consequences, and this is something I've got to say we've been warning about for many weeks in our questioning to fund managers, saying, look, the performance of Nvidia, what does it mean for the market if Nvidia falls? It's been accounting for about a third of the gains you've seen on the S&P 500 so far this year. But also more broadly, if you want to be exposed to semiconductors, and you can only do it through ETFs, it impacts broader semiconductor ETFs as well. And you've seen the consequences there. For instance, the main semiconductor index down about 7% too in the last number of sessions, the last 3 trading sessions. So I think there are broader exposures that people have been overlooking in this race towards getting on board the AI train.
Yeah. Well, good morning to you guys. I'm finally back. So good to be back. But nonetheless, I mean, the Nvidia story, I suppose it's one where people, like you said, have been concentrated on because it has had this lead. But is the party over? Well, the fundamentals haven't necessarily changed. It does follow on from, as you said, Jensen Huang having sold off those shares. But let's remember that most Nvidia employees have actually opted to receive 50% of their pay using stock options, right? And in order to benefit from the company. In fact, Benzinga estimates that employees who joined Nvidia 5 years ago have now become millionaires, which means that there would be that sort of sell-off somewhat in that share price. But the fundamentals of the company haven't actually changed. You still have demand that is still high for those AI GPUs, right? You still have Nvidia set to start shipping its next-gen AI chips, Blackwell. That's only happening later this year, which could spur growth even further for this company. Nvidia revenues expected to double. That's going to hit up around $120 billion this fiscal year. That could be 160 next year then as well. By contrast, Microsoft is only expected to grow by 16% in this fiscal year. Even OpenAI's GPT-5 has been pushed back to late 2025, which will still need possibly Nvidia's chips then. That could add another push to the share price. So those fundamentals are still in play. What could be the biggest problems? Well, capacity bottlenecks, right? They have all of this shipping and all of this demand to still put in place. Will that be a problem for them? Also, could there be potential competition? Yes, there are leaps and bounds ahead of other players, but all of those other players also have got funds that they've been trying to hold back on to then spend in this regard. So will it be in the chip story?
There is very little I can add better than what you two just did as well. But apart from, I just wanted to point out a couple of things. There is not a large short interest out on this stock, for instance. In fact, it's roughly a third of the short interest that's out on a stock like Tesla, for instance. Their short interest is very comparable to the likes of Amazon and Meta, circa 1%, 1.2%, whereas Tesla has 3.2% of its stock out on loan for short interest as well. The valuation of this company, as we all know, it is stretched if you're looking at a one-year basis. But you make the absolute key point that they have the knowledge that their products are going to be in vast demand for a long time. The problem is the exponential growth that they have seen and that the market continues to hope they're going to get. And that's the only way, if you calculate that exponential growth on a 2, 3, 4, 5-year basis, that you can probably justify the valuation at the moment. 40 times forward on a PE, 22 times on a EV to sales. And that's absolutely fine. Why shouldn't we look at a story like this on a longer term basis? But then that brings in what you just said as well there, that the competition is coming up the rails. You made the point many, many times that actually they have an ecosystem which many of the customers feel tied to at the moment. Actually, when they have more options out there, again, that is going to raise questions. But the fact of the matter is, this story, for all of the fundamentals we just mentioned, the stock options, the valuation, it is very much a momentum story. Whether this stock trades at 35 times or 40, 45, 50 times, it's almost academic. It's about the feel of the stock very often as well. And we all know that valuations do matter eventually. In the meantime, in the short term, it's always about momentum.
Let me go back over history, because there was a time when this stock was being sold by many market participants and you had brokers downgrading the stock. This was before the AI story really took off, and I remember seeing the stock downgraded one week, and then the next week it had a double upgrade, and it was like, what is going on? So it was almost like
the analyst.
Well, it was almost like a U-turn, because this AI story came out of nowhere for the company. So it was going in one direction, did a U-turn, then rapidly accelerated, got to about 70 miles per hour, which I think is where we're at now. And the question is whether you jump on board at that very fast pace, or whether you take stock and think, well, I was a little bit too slow to the party, unfortunately. Do I need to wait and see what that earnings potential looks like down the track? We can see the next 12 months is very firm, that's very strong, but what happens after that? And for me, there's going to be so much competition coming to this space at some point. We're going to rethink the way we produce AI-powered chips and AI training, inferencing. That's all going to change in the future at some point. And this is a company that's repurposed its equipment to be fit for purpose, to bridge the gap that we need now. And it's been very dynamic doing so, not taking any positives away from the Nvidia story, but it's the entry point and it's the risk to your portfolio if you jump on board at the wrong time when it comes to a stock like this.
It's 120 where you actually want to jump in. And it's something you've actually previously said as well, Steve, that with a company like Nvidia, you stop looking perhaps at just 1 year in terms of earnings. You start looking 4 or 5 years ahead now in terms of that earning potential.
The reason why we spend so much time on Nvidia is A, it's fascinating because of these absolutely extraordinary gains, but B, because of its ramifications on the broader market. And that's where I kind of want to take this conversation a little bit, if I may, as well. Some good stats. David, our producer, gave me a good stat this morning. I think he got it from the Financial Times, I believe. The S&P closed 0.3% lower on Monday, even as 70% of the benchmark's constituency ended the session higher. Energy up 2.7%. I've also got another stat from the universe of roughly 3,000 companies in the broader NYSE, we saw most companies ending, not most, more companies than not advancing, 1,441, 111 unchanged, 1,350 declines as well. So it does have, unarguably, a disproportionate effect on the weighting of some of these indices, such as the S&P. But what is very interesting is, are we now going to see some rotation and a little bit of caution? Maybe people still want to own their Nvidia, hard not to if you want to get involved in the AI growth story, but maybe lessening some of that positioning and finding other parts of the market.
A make or break moment for the markets potentially if we don't get the breadth. There is some reporting in the FT today from SocGen that if you don't get the breadth, then potentially you could see a tech bubble form. Doesn't think there's one at this stage, but that could happen. That could be the consequence.
Are we scared to call it a bubble? Is one of the questions I'll ask. And I only say that because a bubble doesn't necessarily always mean that you have a company that's going to collapse, right? It just means you've perhaps overinvested in one sector.
Yeah, it tends to mean when you have a bubble, the pricking of that bubble tends to be the inevitable consequence, doesn't it, as well? Most stock market bubbles, whether it be one that, not that I was there for it, but, the tulip bubble, the South Sea bubble, the dot-com bubble, they do tend to end with a pricking of that.
Are we saying that this isn't? This is?
We
I mean,
really don't know.
the questions, of course.
You need to know the use cases for the AI. You need to know how you're going to monetize those use cases. And the reality is we don't have a lot of that information at this stage. All we have is Nvidia and the sort of earnings and revenue numbers that are coming through for that company, which are very strong. But for other big name companies and other challenges, we actually don't know the use cases yet. And we don't know the AI monetization pathway. So it is very hard to tell whether it's a bubble or not.
Big question marks,
Let's push on. The EU has accused Apple of breaching the bloc's tech rules and stifling competition in its app store. The EU regulators have brought charges against the tech giant under the new Digital Markets Act, which forces big tech to comply with strict competition rules. Apple could face a fine of up to 10% of its global annual revenue if it's found in breach of the new rules. In response, the company said it is confident in its compliance. The latest probe marks another escalation in Apple's relationship with the bloc. Earlier this year, the EU imposed a €1.8 billion fine on the tech giant over competition in the streaming space. There's also an ongoing dispute over tax arrangements between Apple and Ireland. Francisco Geronimo joins us now, the VP of Data and Analytics and Devices International Data Corporation. Francisco, nice to see you again.
Hi, good morning.
This is a big one as the regulators are taking a look over Apple at the same time that Apple's trying to push ahead with an AI strategy. And first up, there is this issue that there needs to be other ways to access apps other than the App Store. This is what the European Commission is looking at. Is that fair at this point?
Well, indeed, what the European Commission is really pushing is to open competition in the Apple and the iOS, particularly ecosystem, by allowing other developers to launch and make available other marketplaces to distribute apps rather than for us as users just to having access to the App Store as the only way to get the apps.
It's like a shopping mall, right? So you go to a shopping mall, a shopping centre is owned by the same group, you keep popping in there, going to a variety of stores, but overall the centre is owned by one place. We're saying in a marketplace online, there must be other options now.
Exactly, but what the European Commission is saying is that any shopping mall should allow any company to distribute their products in their shopping mall and without charging for that specific business. Because what Apple introduced early this year was an alternative to app developers where they could choose between the current model where they pay 30% of what is sold in the App Store or a reduced rate if they are smaller developers, or a new model to comply with EU where developers can launch their marketplace, can distribute their own apps through their marketplaces in the iPhone on iOS, but they will have to pay Apple a fee, the core technology fee, and that's what the European Commission is challenging, whether this fee and also the requirements for Apple, for app developers to launch their app marketplaces are fair or not.
If I'm Westfield,
That was the obvious one that came up, right?
yeah, exactly. Yeah. I'm just following you. Okay. Yeah. If I'm Westfield, I mean, which owns significantly huge malls in West and East London, if people don't want to come to my store, that's my mall. That's fine. They can go elsewhere. If you don't want to have access to the customers who only want to come for the experience I'm producing at Westfield or wherever it may well be. Brent Cross when I was growing up in the 80s. There you go. There's a blast from the past. Then go elsewhere. Isn't that a legitimate argument? If you don't like it, if you don't want access to what we've created, then go elsewhere.
But what the European Commission is saying with this
you've
investigation,
become so successful.
Exactly, you are so big that you don't allow smaller developers to succeed and to sell their applications. What the European Commission fails to understand is that you go to Westfield because you like the experience, because Westfield or the company behind spend billions perfecting that experience.
Yeah.
And if you need to open your shopping mall to anyone to sell their products, how do you guarantee the quality of the experience?
There's no other high streets around in the internet marketplace, right? But even if you find your way...
point out that Shepherd's Bush is about 3 stops from Oxford Circus, which is one of the biggest shopping streets on the planet.
On the internet, this is the problem. There's no other, seemingly no other high streets you can stop at on the internet. If you do stop there and it's through a web browser directly, often you end up using Apple Pay to complete the transaction as well, so they're still clipping the ticket.
Let me go for another analogy before you answer. A friend of mine had a mid-sized business, small to SME, which has been selling a product for about 250 years. Now, obviously, their channels to market became tougher. They used to use a very, very well-known middle-class high street chain, or it was supermarket, department store chain for distributing the goods. But that department store asked for so much money. They actually then went to a very well-known online marketplace that begins with A and ends in Maison, and actually had to give Amazon their clip of ticket, but actually their sales went through the roof because they got access to the Amazon marketplace as well. Yes, you're giving up a large percentage of your potential revenues, but the amount of money that you are making because you have access to that market is disproportionate. I mean, just jump in.
That's absolutely right. Apple opens a door to the world for all these small app developers, and the majority of them will not sell enough to pay the billions that the large developers like Epic Games
Lipsy, page 36 or whatever it is, economies of scale. They need the economies of scale of being in that marketplace.
Exactly. And that's and when we look into the other big ecosystem, which is Android, and Google in particular, they allow other marketplaces to succeed and to be available on Android devices. Samsung App Store, Huawei, Amazon Marketplace, etc. But the majority of consumers continue to go to Google Play because it's the best experience and provides the most secure experience for Android users. The same way as Apple wants to guarantee the experience and the security for their customers.
Can we get to the consequences then? Yeah. Can the European Commission actually bring about change where some other app store comes out of nowhere challenging the services that Apple's able to collect? Number one consequence. The second consequence is, what about the rest of the companies, Meta, Google, that are also being scrutinized under the Digital Markets Act now by the Commission?
The European Commission is also looking into Google and the Google Play practices to see if there's also some non-compliance procedures with the DMA, the Digital Markets Act.
I don't want to let you go because you're such a brain box on this stuff as well. Can I take a step back holistically? Is Europe determined to destroy all technological companies or just American ones? Because let's be brutally honest about it. The regulatory environment in Europe, and I'm going to switch sectors now to the telecom sector for technology. The European technology sector is in tatters because of the regulatory environment imposed by Brussels and national governments as well. They have enormous capex to bring on the new technology, but have zero profitability compared with the tech companies as well. Does Europe ever think about building companies rather than destroying companies?
Well, the European Union is trying to make a point in terms of regulation. They really want to control.
Show me the customer who doesn't want to pay the money that they have to pay for their mobile contract to get access to this stuff.
Exactly. And by bringing all this regulation into place, yes, it protects the citizens, it protects the consumers, but at what cost? Because at the end of the day, smaller developers in this specific case will not succeed even if they have the entire Apple doors open, because there's a lot of money that goes into research and development and promotion of those apps for them to really
have to
succeed.
Let you go. I'm gutted because obviously we got Dalian after the break as well. But thank you so much
very
indeed.
much.
I think genuinely this is a fascinating conversation on so many levels. Please
and
join us.
It will put you at risk, especially with AI becoming such a disruptive
You just
technology,
mentioned
and
that.
Apple is delaying the launch of Apple Intelligence, and other players are really reconsidering whether they should make
Do you
them
mind if we
available.
book you in for another? We break a rule, but in a
it's a
couple of
pleasure.
weeks' time we'll do this again soon.
Thank you.
Thank you very much. Francisco Geronimo, who is VP Data and Analytics and Devices at International Data Corporation. I think we could have done an hour there, couldn't we?
Definitely.
Sorry, Arabino, please take it away.
Well, nonetheless, coming up on the show, Chinese Premier Li Qiang says EV production in the country is benefiting the whole world. We'll bring you the latest from Summer Davos in Dalian. That's coming up next. Plus, a guidance cut for Airbus as supply chain problems hit the plane maker. We'll break down the details of that one next. And we'll then be looking ahead to the French election ahead of this weekend's first round of voting with Mohit Kumar, who is the chief financial economist for Europe at Jefferies. That interview is coming up at 7:30 CET.
Ambition to me is about doing better.
I think ambition creates a pathway.
The best advice I can give to someone starting off a career is don't have a career, have lots of careers, try loads of different things.
Talk to people and put your ambition out there.
I don't feel that I've hit peak ambition because it's a learning journey.
CNBC is where ambition meets opportunity. What does living ambitiously mean to you? Hear it from our CNBC anchors, reporters, and global business leaders on CNBC.com.
Welcome back. Eurofins Scientific has responded to allegations made in Muddy Waters' short report after its publication Monday sent shares down. Well, they go down more than 15% in a session, wiping more than €1 billion off the firm's market value. In a statement, Eurofins branded Muddy Waters' allegations as blatantly wrong and misleading and said many of these claims have already been addressed at length by the company in multiple disclosures. Eurofins says it is completely confident in the integrity of its accounts and will provide detailed refutations, what a great word, refutations in due course. We've already discussed it, but what a fascinating market session that was.
Yeah, Nvidia on the decline, and that's impacting the market fortunes that you're witnessing. For the Dow, back in the green again, a bounce of almost 0.7%, fifth positive session in a row. But in contrast to that, a third negative session playing out for the S&P 500, sliding 1/3%, and also a third negative session for the Nasdaq, down near on 1.1%. So the reversal taking place there. Nvidia now losing about 500 billion in market cap since it became the world's largest company last week. The shares continue to fall, down almost 7% in session yesterday, and again slipping in terms of leadership. It had crossed Microsoft, now it's back beneath Microsoft and Apple, back in third position. Take a look at the tech universe, because tech has been one of the better performing sectors of the market recently, and Nvidia's story just in the last couple of days somewhat undermining that. So yesterday tech was actually the worst performer. It was down 2% over the course of the month, though tech has been leading. It's up 7.5%. So the picture we're seeing: Apple, Meta, Alphabet still short, but still very slimmer ranges versus what we've seen in recent sessions. Other major trades: Nvidia sliding almost 6.7%, Amazon going with it, marking lower to the tune of 1.8%. Asian markets picking up on some of that negative lead that we're getting from those technology plays across in those US markets. The Asian markets today in session. Don't forget there's a big event playing out too around China with the so-called World Economic Forum in China. But those market ranges seem to have disappeared, so we'll try and do it at another stage, Steve. I can't make up words that I don't have.
Did it just go on you?
Yeah.
Oh, that's a new one, isn't it?
I was going to try and draw them, use my artistic skills, but I think we'll just push on.
Oh, I would have done that. That'd been great if you had a marker pen. The Chinese Premier, Li Qiang, says the country's rapid ascent as a global leader in EV production is enriching the global supply of new cars. Very interesting. Brushing off trade tensions with the European Union and the US. Li was speaking at the start of the World Economic Forum's Summer Davos meeting in Dalian, where he also maintained the country will hit its 5% growth target this year and keep the economy moving on a steady upward path. Well, Sam, who's in Dalian, wow, Sam, it's already fascinating, that comment about enriching the world on the EVs rather than being to the detriment of the European and US producers.
I think this was one of the most interesting parts of his speech because a lot of it was really consistent with what we've heard before from Premier Li Qiang and sort of the official line around hitting that GDP growth target, as you say, around new productive forces, of course, warning against decoupling and this sort of block confrontation. But as you mentioned, Steve, really on the issue of some of the products that are being targeted right now by so-called protectionist measures. And what he said about the EVs and the batteries was fascinating because no doubt, as Premier Li's speech went on, the big elephant in the room is these rising geopolitical and trade tensions we're seeing playing out at this very moment with, of course, the EU tariff threats. And what's different about that, of course, in your part of the world, which is different to the US, is that they're taking a sort of more nuanced approach. It has very much left the door open to negotiations, which we are starting to see a willingness on both sides to sort of come to the table and find out what's sort of mutually acceptable here. But really, as I mentioned, the elephant in the room. And so take a listen to what he had to say about some of those products, which China, of course, has been making and exporting to the rest of the world.
The advanced electric vehicles, lithium batteries, and PV products made by Chinese companies have not only met domestic demand, but also enriched supply in the international market. It has also eased the pressure of inflation worldwide and made our active contribution to the global climate response. The rapid rise of China's new industries is rooted in our unique comparative advantages. The economies of scale can effectively help to reduce innovation costs for enterprises and accommodate the growth of different technology roadmaps and business models in China. And that is how China's emerging industries get their competitiveness.
So the message there is really, you wanted these cheap and green products. We gave them to you. It helped ease some inflation and we played a part in some of these global climate efforts. So really this was defending China's development over the years, which is very much being pressured right now, and doing it not in so much a hostile way where he didn't call out any countries in particular or name any names. He did it by really emphasizing what China has been doing in terms of some of its supportive industrial policy. So it's been really fascinating to hear him not just addressing overcapacity directly, but talking about what China has been doing around new productive forces. And I've been speaking to a number of analysts in terms of their reaction to that speech. And no doubt this is a troubling environment, not just for MNCs, but Chinese companies domestically as well. Everybody's competing for a slice of the pie. Are we seeing new productive forces in action? Yes. Are companies making money? Perhaps not just yet, because there is a lot of price competitiveness here at the moment. But he also did talk up confidence in hitting that GDP growth target. Take a listen.
The rapid growth of new industries and new drivers has buttressed the sound and sustained development of the Chinese economy. Since the start of this year, the Chinese economy has sustained the momentum of recovery. It got off to a good start in the first quarter of this year with a 5.3% year-on-year growth and continued steady growth in the second quarter. We are confident and capable in achieving the growth target of around 5% for this year.
So as you heard, they're confident in achieving that GDP growth target, but the big question remains, are these policies pushing it certainly in the right direction? I mean, an $18 trillion economy growing at around 5%. China is facing a transition to more structural, lower growth, but of higher quality. But still, there are many concerns about some of the issues around the property sector and, of course, youth unemployment running at a record high.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.